Welcome to Earnings Recap, your audio summary of the latest company earnings reports.
Glad to be here.
Today, we're diving straight into Intel's first quarter 2025 earnings release. That just came out on April 24th.
Yep, hot off the press.
And the idea here is, to give you the key takeaways. We're talking revenue, profit, earnings per share, how it compares to last year, and what they're forecasting.
Exactly. All the crucial stuff for, busy investors who don't have time to read the whole dense report. We've pulled the highlights from that official Q1 PDF.
Okay, so let's jump right in. Revenue. What's the big number for Q1 2025?
The top line was $12.7 billion.
$12.7 billion.
Okay, and how does that stack up against last year?
Well, that's the interesting part, actually. It's basically flat. Same number, $12.7 billion in Q1 of 2024.
Huh. Flat year over year. So no growth on the surface?
Right. But, that headline number never tells the full story, does it?
Definitely not. So if we look underneath that at their actual products, so total Intel products revenue, that was $11.8 billion. And that was down slightly 3% year over year.
Okay, so a little dip in the core products, even though the overall number held steady. That means things must be moving around in the different business units.
Precisely. You've got different trends happening all at once. Should we break those down?
Yeah, let's do it. Client Computing Group, CCG, that's the PC stuff, right?
That's right. Your laptops, desktops. That came in at $7.6 billion.
And that was?
Down 8% compared to last year.
Okay, so a bit of weakness there. What about data center and AI, DCAI?
No, that was a different story. $4.1 billion in revenue, and that was up 8% year over year.
Right, so strength in data centers. Makes sense with all the AI buzz. And Intel Foundry, their manufacturing arm.
Also showing growth. $4.7 billion for the quarter, which is up 7% compared to Q1 last year.
Okay, interesting. So CCG down, but DCAI and Foundry up. What's left?
You got the all other category. This includes things like Altera, Mobileye.
And how did that do?
Really well, actually, at $0.9 billion in revenue. But that represents a huge jump, 47% year over year.
Wow, 47%. Okay, so definitely a mixed bag. Flat overall, but, PC chips down, data center and Foundry up, and then this other category way up.
Yeah, it really paints a picture of shifting priorities or market dynamics. The traditional PC market may be facing headwinds, while AI, data center, and these other bets are growing.
Okay, so that's the revenue side. Let's talk profit. Did that $12.7 billion translate into profit? How's the bottom line look?
Well, on a GAAP basis, that's the standard accounting method, Intel actually reported a net loss attributable to the company.
A loss? How much?
It was a loss of $0.8 billion for the quarter.
$0.8 billion. And how does that compare to last year? They lost money last year too, didn't they?
They did, but it was less. In Q1 2024, the GAAP loss was $0.4 billion. So the loss actually got bigger.
Bigger? By how much?
It's a 115% increase in the loss year over year.
Oof. Okay, so revenue flat, but the loss more than doubled on a GAAP basis? Not great. How does that look per share, the EPS?
Right. The GAAP earnings per share, or loss per share in this case, diluted was negative $0.19.
Negative 19 cents, and last year?
Last year was negative $2.09. So again, a big jump down, 111% worse off per share.
Okay, so GAAP profitability definitely took a dive. What about non-GAAP numbers? Sometimes companies prefer to highlight those.
They do. They report non-GAAP figures to sort of smooth out certain items. And on that basis, Intel reported non-GAAP EPS of positive $0.13.
Positive 13 cents. Okay, so they're showing a profit on that adjusted basis, but how does that compare to last year?
Still down. In Q1 2024, their non-GAAP EPS was around 18 cents.
Ah, so even the adjusted profit is down by about, 28%?
That's right, a 28% decrease year over year for non-GAAP EPS. So yeah, whichever way you slice it, profitability was weaker this quarter compared to last.
Yeah, whether you look at the standard GAAP or the adjusted non-GAAP, the trend is down for profits.
Exactly. The GAAP numbers give you the full picture with all the accounting rules, while non-GAAP tries to show underlying operational performance. Both pointing downwards suggests, some real pressure.
So recapping the year over year, flat revenue, but significantly lower profits, both GAAP and non-GAAP. Were there other key financial changes, like margins?
Yes, good point. Gross margin also declined. The GAAP gross margin fell to 36.9% from 41.0% last year.
And non-GAAP?
Same trend, down to 39.2% from 45.1% in Q1 2024.
So they're making less profit on each dollar of sales, essentially. That lower margin suggests maybe higher production costs or pricing pressure?
Could be either, or maybe a mix of both.
Yeah.
or even just selling more of the lower margin stuff definitely squeezed profitability.
Interestingly, though, didn't they cut some spending? I thought I saw something about R&D and administrative costs.
They did, yeah. That was kind of a counterpoint.
Yeah.
R&D and MG&A expenses on a GAAP basis were down 19% to $4.8 billion.
19%, that's quite a cut.
And the non-GAAP figure for those expenses was also down by 15% to $4.3 billion.
So they are trying to control spending in those areas, but I guess it wasn't enough to offset that gross margin pressure we just talked about.
Seems that way. Cutting operating expenses helps, but if your core profitability per chip, your gross margin, is falling, it's hard to overcome that entirely.
Makes sense. Okay, let's pivot to the future. What's the outlook? What did Intel guide for next quarter, Q2 2025?
All right, for Q2 guidance, they're expecting revenue between $11.2 billion and $12.4 billion.
So the midpoint of that, what, $11.8 billion? That's actually lower than the $12.7 billion they just did in Q1.
It is. It suggests they see maybe a bit of a sequential dip coming up in the second quarter.
And what about profit expectations for Q2? Is that looking better or worse?
Well, the guidance for GAAP EPS is for a loss of 32 cents per share.
Another loss, and bigger than Q1's negative 19 cents.
Right. But then the non-GAAP EPS guidance is for $0.
Zero. So breaking even on an adjusted basis.
Basically, yeah. Break-even non-GAAP EPS is the expectation for Q2.
That's a pretty big difference between the GAAP outlook, negative 32 cents, and the non-GAAP, 0. What does that imply?
It suggests there are some significant adjustments or one-time items expected in Q2 that are hitting the GAAP number but are excluded from the non-GAAP calculation. Things like restructuring costs, maybe.
And what about gross margin guidance for Q2? Is that expected to recover?
Not really, according to the forecast. They're guiding for a GAAP gross margin of 34.3% and non-GAAP of 36.5%.
Both lower than Q1. So that margin pressure seems set to continue, maybe even intensify a bit in Q2.
Yeah, the guidance points towards ongoing challenges on the profitability front in the near term.
Okay. So Q1 results were mixed. Q2 guidance looks a bit cautious. Did they announce anything else? Any strategic moves or big news alongside the numbers?
They did, yeah. Quite a few things, actually. They talked a lot about improving execution and operational efficiency.
Yeah, so.
Things like streamlining the organization, cutting management layers, basically trying to become leaner, more agile.
And does that translate into financial targets? Are they aiming for lower costs overall?
Absolutely. They lowered their non-GAAP operating expense target for the full year 2025. It's now around $17 billion, down from $17.5 billion before.
Okay.
And they're targeting even lower for 2026, aiming for $16 billion. They also cut their planned capital expenditures for this year.
How much did they cut CapEx?
Down to $18 billion from a previous plan of $20 billion. So, yeah, definitely a focus on being more disciplined with spending.
Got it. Cost control is clearly a theme. What about technology and products? Any updates there?
Yes, some important ones. They reiterated the plan to ramp up their Intel 18A process technology in the second half of this year, 2025.
That's their next big manufacturing node, right? Crucial for catching up.
Exactly. Very important for their foundry ambitions and their own products. They also mentioned launching the first Panther Lake chips, that's the next CPU architecture, by the end of this year.
Okay, so new tech is still coming down the pipeline.
Yep. And there were also some pretty significant portfolio changes announced. Business sales, basically.
Oh, yeah. Like what?
They made a deal to sell a majority stake, 51% of their Altera business.
Right.
That's the FPGA company they bought a while back.
Who are they selling it to?
A private equity firm, Silver Lake. Intel will keep the other 49%.
So partly divesting Altera. What else?
They also completed the final step of selling their NAND flash memory business. That deal was with SK Hynix, and the second final closing happened in March.
Right, I remember that sale was ongoing. So selling off NAND completely, selling a majority of Altera, sounds like they're trying to focus more on the core CPU and foundry businesses.
That certainly seems to be the strategy.
Yeah.
Streamlining the portfolio, focusing resources.
Okay, and just quickly, did the CEO or CFO add any particular color in their comments?
Pretty much aligned with what we've discussed. The CEO, Pat Gelsinger, talked about, gaining share, driving growth, but also really emphasizing the actions they're taking on execution and efficiency.
And the CFO?
David Zinsner acknowledged the uncertain macro environment, as you'd expect, but highlighted their disciplined approach to spending and investments. So the commentary really backed up the strategic actions and the cautious near-term outlook.
Okay. So let's try to wrap this up. The key takeaways from Intel's Q1 revenue was flat year over year.
Right, but profitability was down significantly, both GAAP and non-GAAP.
And performance was really mixed across the different segments. Client computing down, but data center and foundry showed growth.
And that all other category had that huge jump. Plus, the forward guidance for Q2 looks a bit weak, pointing to maybe a slight dip in revenue and continued pressure on margins.
But alongside that, they announced some pretty clear strategic moves. Big focus on efficiency, cutting costs, reducing spending targets.
And shedding non-core assets like NAND and part of Altera, while pushing ahead with key tech like Intel 18A and Panther Lake.
So for you, the listener, maybe the thing to ponder is how this strategic shift plays out. Can Intel execute on this efficiency drive?
Yeah, and will those upcoming product launches like 18A and Panther Lake in the second half of the year be enough to really turn things around? Especially given, the tough economy and fierce competition.
Right. And think about what selling off NAND and reducing their stake in Altera means for Intel's future shape and focus. Lots to consider there.
Definitely. It's a company in transition, trying to navigate some significant challenges while betting on its future technology.